Today's non-farm payroll number all but solidified another 75 basis point hike by the Fed at the November meeting, and then probably another 50 basis points in December. Heading into 2023, you're probably looking at smaller incremental hikes by the Fed, maybe 25 and 25. I think the accepted terminal funds rate right now is sitting at 465. It's down slightly from 475 just last week. The market volatility and uncertainty and liquidity problems that we saw over the last month have definitely subsided as cooler heads have prevailed. The Bank of England stepped in to do something rather dramatic. They moved from tightening policy to quantitative easing literally overnight. They were forced to do that because their pension funds, which are very large in the UK, were faced with margin calls, and the risk of them going bankrupt increased dramatically. So what they did is they came in and they started to do buybacks. Now, the way buybacks work is interesting. Every day at a certain time, the Bank of England looks for offers from market participants. Participants submit their offers to the market, and the Bank of England literally looks at a list of bonds and says, okay, I'll buy this, 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 and this. What's interesting is the Bank of England hasn't really been buying bonds in these buybacks. So it was almost a smokescreen or a means of buying time so that the UK pension funds can raise cash and get their liquidity in order. The equity market is going to be dominated by technical flows, mainly option flows in the form of large call buying. As more call options are sold, should the market rally, those who sold those call options are forced to delta hedge themselves. So it becomes a buying on top of buying. So we are at risk to another short squeeze in equities, especially if earnings are good, which kick off next week. I would use any significant rally in equities or risk assets to pare down my risk. We're seeing a lot of deflationary pressures out there. Cargo ships are literally dropping anchor and electing not to ship goods on half-filled cargo container ships to the US. Inventories are building. So the market got bullwhipped from a scarcity of everything after COVID to now a glut of inventory. And the only way to clear an inventory is simply to reduce prices. So again, deflationary pressures. I don't think the market's paying enough attention to these deflationary pressures. And it's also the reason why we're not seeing our long end rates in the US reflective of a 465 terminal funds rate. So the Fed is going to keep hiking, but they're going to be faced with an interesting conundrum. They're going to be forced to keep hiking rates in the face of a clear recession. They're going to have to channel their inner Volcker from this point. Will the Fed capitulate? I don't think the Fed's necessarily going to capitulate, but they are feeling a lot of pressure from other central banks, as well as the UN, to slow their pace of rate tightenings. For the portfolios that I help manage the hedges for, all correlations have broken down. It's become very difficult to hedge any fixed income products. Normal hedge ratios are completely broken down, and it's a market that favors the nimble. In other words, if you can move in and out of your positions pretty quickly or hedge yourself, you're going to be far better off than the simple buy and hold strategies from here. I firmly recommend that people look at the market objectively and pare down risk at the right opportunity. There's no need to be a hero in this market right now. It's about survival.